It's my pleasure to be back again and talk about our quarterly results. At the very outset, I would state that we had an absolutely outstanding quarter and we set several records both in operating and financial performance. To begin with, our consolidated PBDIT was 12,636 crores, up 4.5% quarter on quarter. If we look at our consolidated net profit, we reported rupees 6,720 crores, up 8% quarter on quarter and 12.5% year on year. We had two extraordinary items, netting those which had a positive impact of 252 crores. Our consolidated net profit was 6,468 crores, up 4% quarter on quarter and 8.3% year on year. If we look at our margins, standalone margin for EBITDA was 15.8%, nearly 700 basis points up year on year, and standalone EBIT margin at 11.1% was nearly double from 5.5% a year ago. This performance comes on the back of both margin expansion as well as higher volumes. We saw margin expansion in our refinery business as well as petrochemical business, and we saw increased volumes primarily in our petrochemical business. In the refining business, we had a gross refining margin at $10.6 a barrel, which is a 7-year high. We also had outperformance with respect to Singapore complex of $4.3 a barrel, which is the highest that we have seen in the last 6 years. In our petrochemical business, production growth of 7% quarter on quarter, coming on the back of additional volumes from PTA and PET, which we commissioned earlier this year. In the oil and gas business, the exceptional items relate to our sale of our midstream interests in the US, which gave us a one-time gain in excess of $700 million. And at the same time, we did a review of our shale gas portfolio, and in view of the lower price environment, we thought it would be prudent to take an impairment of roughly $630 million. Net of these two, as I stated earlier, we have a gain of 252 crores from our shale gas business. In the retail business, we reached a very important milestone, exceeding 5,000 crores of revenue in this quarter. Let me spend a couple of minutes now talking about the macro environment that we operated in. In this quarter, oil prices dropped roughly 19% from $62 per barrel to about $50 per barrel. When we look back at this 9-month period, starting from Jan 1, prices have dropped from $106 a barrel to about $55 a barrel, and they have roughly halved in this period. This is, as we all know, one of the highest declines that we have seen in the past decade in oil prices. The good news is that demand has responded strongly. As per the latest estimates, we think that oil demand in this year would grow by roughly 1.8 million barrels per day as compared to only 800,000 barrels a day. Over and above that, the estimates are that oil demand would grow by roughly 1.2 million barrels a day in 2016. And if we take 2015 and 16 combined, a growth of 3 million barrels a day would be among the highest that we have seen in this industry in a very, very long period of time. This has also reflected positively in the Indian environment. We saw diesel demand grow at 8% year on year, and we saw petrol gasoline demand grow at 16% year on year. As far as our petrochemical business is concerned, we saw polymer demand grow roughly 12% year on year, and polyester growth was a bit modest, but even then we saw 2% growth year on year. So in essence, we had a very strong demand and margin expansion environment both globally as well as in India. Let me talk for a couple of minutes on our refining business. Firstly, refining EBIT at 5,461 crores for this quarter is 42% higher than year on year. This is again a remarkable improvement. EBIT margin at 9% is 5.3% higher than year on year. So, in effect, our EBIT margin has more than doubled in this quarter. We did well in operating our refinery as usual at 17.1 million tons of crude processing with the capacity utilization at 110%. The industry globally has also done well. US refineries have essentially operated around 90% and Asian refineries have operated between 84 and 85%. Refining margins were healthy around the world. US refiners have a natural advantage because of landlocked crude and obtained $20 GRM. As far as we are concerned, we significantly outperformed Singapore complex as we make no fuel oil, while the benchmark refinery as far as Singapore is concerned has a decent amount of fuel oil production. Gasoline was the real star in this quarter as well as in the previous quarter, with gasoline cracks at above $19 a barrel coming on the back of a strong driving season in the US and increased demand as we've talked about in India, China and other parts of Asia. Diesel cracks were a bit subdued at just under $11 a barrel, simply because we saw new refineries who are diesel heavy commission in the last year or so, and that product looked a bit oversupplied. Fuel oil cracks widened from roughly negative $5 a barrel to negative $10 a barrel, and this helped us as several of the heavy crudes that are available globally are priced benchmark to fuel oil. In short, refining had the best quarter in its history and a big improvement over last year. As far as petrochemicals business is concerned, we did see some margin improvement. Petrochemical EBIT at 2,531 crores and EBIT margin at 11.9%. We saw a full 3% improvement in margins compared to same time last year. The volume was up 7% quarter on quarter because of increased capacity in PTA and PET. When we look at the individual sectors within the petrochemical business, the polyolefins chain, we saw stable margins. The cash cost of ethylene followed lower naphtha prices, and given the strong demand in this part of the world, the margins between ethylene and the derivatives remain constant. Polyester chain margins expanded 8% quarter on quarter and 25% year on year and exited at roughly $650 per metric ton. Essentially what we are seeing is that the demand growth across all the sectors, both in polymers, polyester, fiber intermediates, is giving a firm base to the margins, and as we see continued increase in demand on the back of 7+% economic growth in India, we think both transportation fuels and petrochemicals will continue to do well, both in volume and margin growth. Our E&P business has become more modest and a smaller part of the company over the years. The domestic revenue in the E&P business was just under 1,200 crores with an EBIT of just about 60 crores. Our US shale gas business is also highly levered to commodity prices, and even though the volume is stable at roughly 51 BCFE equivalent, we have had continuous lower price utilization because of lower oil prices, and essentially we are continuing a path of being conservative in investment and conserving capital in our US shale business. The retail business has done well. It is profitable. We crossed the landmark of 5,000 crores of revenue in this quarter. We opened 110 stores in this quarter. We added stores in fashion and in digital format, and revenue growth has been strong both in digital as well as fashion in this quarter. To To round it off, our financials continue to be strong. We spent just over 20,000 crores in capex this year, and all our ratings continue to be at AAA, and our international ratings continue to be investment grade. Thank you all for watching me on this update.